He says this isn't a pullback or a recession so much as a post-pandemic replenishment cycle. Let's bring in Simeon Siegel. He's BMO Capital Markets Senior Retail Analyst. Great to see you again, Simeon. Welcome.
Hey, Kelly.
I've been following, as you've been following the saga with Weber and the grill, and all these different consumer companies. What do you think is really going on here?
Yeah, it's funny. I was thinking about it this morning. You and I think it was, I don't know, let's call it 2.5 years ago almost. We came here and we said, did COVID actually save retail? And the main premise was if you sell less and charge more, you can decide what's a healthy sale. On the other side, we've completely forgotten all of it. I mean, we're going right back to what retail has historically been of, I have inventory, I need to sell it, people aren't buying it, let me discount it.
True.
And what if it's as simple as people bought a lot of things? And if people bought a lot of things, maybe give them some time to digest them. And so I think that's what we're dealing with now. And I think, again, you and I have talked about this, I think we're on this replenishment arc cycle where people are looking at consumer staples versus discretionary, high income versus low income. What if we should just think about it in the context of if I've used up what I've already spent, if it's a box of cereal, I need to go back and get it, which means it's going to be inflationary. If it's a Peloton bike, I already have it, I don't, which means the discounts are going to fly, and everywhere in between. That's how we're looking at the group right now.
It makes total sense to me. So I guess what inning we're in depends on what product we're talking about. But who do you think is already through the worst of this or well-positioned for that, kind of turnover? And who's going to continue to struggle for maybe years?
Yeah, it's such a great question. The way we're thinking about it is we are trained to think about company sizes in terms of annual revenues. But the consumer didn't shop in annual revenue terms last year. So for products that may have absorbed 18 months of demand in 12 months, we'd have to wait 6 months. If they absorb 2 years of demand, we have to wait 2 years. And so that's this idea of thinking about the replenishment curve. And so the faster you are, the quicker you'll come back. If I bought a bunch of 3-wick candles from Bath & Body Works and I still haven't burned all of them, give me a chance to burn them because then I will come back. And the question is, what's the price point I'm paying when you do? And so that's why I think it behooves the companies, the management teams, to try and do this analysis and figure out for their specific product, when is our customer going to come back? Because I think you and I talk about price elasticity of demand all the time. People didn't push back when people raised price. Why do we think they're going to chase them here? There's no price that's going to get you to buy another grill if you already bought one.
Yeah.
And so from that perspective, that's why I'm trying to think duration-wise. Right now, if I was jumping on something right now, I want to think about those smaller replenishment cycles. The candles will burn faster than a pair of sneakers, which will go faster than a big ticket item. But if you and I are allowed to think longer term, if we're allowed to think about, hey, you know what? The same way that the pendulum across retail swings wildly in both directions, if we can think about companies that are set up better for the future, then you don't have to say no to a grill company. You have to decide when you think the right price is and when it'll come back and know that they're trusted with you. So I would just say the 3 companies that we're looking at right now that I think are doing it right, Capri, which is the parent company of Michael Kors, Versace, Jimmy Choo, has been explicit that they are not going to chase promotions for market share. That is very different. Most companies aren't saying that. If they can hold that, all we have to do is get past that cycle. So I think that's pretty compelling, and they're cheap. And then I think Bath & Body Works and Under Armour are 2 other companies that have emerged stronger after retail, after the pandemic. I just hope they hold on to those promotional cadence and realize that brand equity.
Very interesting.
That they earned will stay.
Under Armour, why does that one jump out to you as one who's improved as a result here?
So, right, it's funny because you and I historically have been on the other side of this conversation. So pre-pandemic, Under Armour was a cash-burning business weighed down by a whole host of fixed costs, whether it was an expensive UCLA endorsement contract, whether it was a big Fifth Avenue plan, whether it was a connected fitness arm. They got rid of them all. So they took the pandemic. They said, you know what, we're going to see our revenues collapse anyway. Let's take advantage. Let's look inward and let's change the business. That's when we flipped our opinion. That's when we started saying, you know what, this went from a cash-burning business that had never bought back a share of stock to a cash-generating business that had liberated itself from a host of fixed costs and watched its gross margin go up in the meantime. Now, they have to keep that going. And that's the hard part. Because the moment you start chasing revs, the moment you say, wait a minute, market share is the name of the game, well, then you start quickly falling back into that cycle. And I really believe, as much as we wanted to say the reason that retail in North America was dead for the last 15 years, everyone attributed it to over stores. I think it was just because of over discount. And that's what we learned the last few years. And I think the companies that can take that and don't get stuck in the, oh my God, no one's buying my product now. Of course, no one's buying your product now. They have 6 pairs of sneakers they bought the last 2 years, but they're going to buy them once they wear them through. And that's why I think these companies make Under Armour is in a better position than it was before. All we have to do is look at the cash flow to see that.
Very, very interesting. So Under Armour, Bath & Body Works, you like, and Capri Holdings. Do you mind calling out any of the ones that you think, unless they change here, or maybe they're doing the things that kind of give you all the wrong signs?
Yeah, so I think, you called them out when we saw with the grill manufacturers. Obviously, you and I have talked about Peloton a lot. I think what you have to do, there's an element of where you born, right? What's the hand you're dealt with? And if you happen to be structurally a category with slower replenishment, it's harder for you to appreciate that you might go a while without revenues. Now, I think that was this unlock. I think that was the awakening this quarter. I think the grill manufacturers were late to that game. But you have Traeger coming out last quarter saying, by the way, our revenues next quarter are going to be down 50%, 50. So I think it's a matter of like when people can wake up to this notion and say, you know what? Everyone understands that if a brand selling into a department store, if they're overselling, they just stop selling, they pull it back. But when a retailer sells to a consumer and forces it down their throat with promotion, that being unhealthy, that for some reason is harder. And that's what I want everyone. That's what I think we need to appreciate, that if the consumer is not buying right now, not necessarily because they can't, it might just be because they don't need to. They don't want to. They already have your stuff.
And maybe that's the big conclusion, exactly what you said about Jimmy Choo. It can hold true elsewhere if you hold the price, if you hold the attractiveness, that, you know, the analyst community like yourself will forgive you in the long run, even if those revenues dry up. Simeon, we'll leave it there. Appreciate it. Good, great to check in.
Great to see you.
Simeon Siegel.
Shepard Smith here. Thanks for watching CNBC on YouTube.